Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at ONDS holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For us, this company is, well, it's the ultimate high-stakes gamble right now.
It really is. A defense and autonomous systems firm that's just... It's showing growth figures you almost never see.
Right, not outside of, the most successful Silicon Valley startups. So I think we have to start with the revenue. That's the headline here.
Explosive doesn't even begin to cover it. The numbers are legitimately staggering.
So what are we talking about for Q3 2025?
Okay, so they hit $10.1 million in revenue. And for anyone listening, you need to contextualize that number.
It's not just the number itself, it's the growth rate.
Exactly. It's a six-fold increase. Year over year, we're talking 582% growth. And it's not slowing down.
No, it's actually accelerating. It was up 60% just from the previous quarter.
Which to me says this isn't just about finding a market fit. This feels more like market capture happening at breakneck speed.
And that's fascinating because that kind of velocity usually screams unsustainable cash burn.
Right. You assume they're just bleeding money to get those sales.
But the sheer magnitude of this increase, it signals one critical thing. Their technologies are going from these small pilot projects straight into massive scalable deployments.
And management sees it too. They're leaning right into that acceleration.
They just raised their full year 2025 guidance
to at least $36 million.
Yeah.
Which, blows past what they were targeting before.
Yeah.
But that's not even the big number.
No. The number that really anchors the whole bull case is the 2026 target.
$110 million in revenue.
That is a massive, massive leap. And it requires a serious reality check. You have to ask, is that credible? Or is it just management hype to boost the stock?
Well, I think the credibility comes from a couple of places. First, it's the efficiency gains. This isn't just top-line vanity growth. Their gross profit in Q3 jumped to $2.6 million. A year ago, it was basically nothing.
So that shows they're getting those economies of scale. They're moving toward the high gross margins they promised.
Exactly. They're still reporting a net loss, of course.
Yes. Q3 EPS was, -3 cents?
But the trajectory is what matters. They beat Wall Street consensus by 2 cents. They're showing that every dollar of revenue is incrementally more profitable.
Which is the exact blueprint a growth investor wants to see. The question becomes less about if they'll be profitable and more about when they hit that required volume.
And that leads us to, I think, the most crucial part of this entire story. When you see this kind of growth, this kind of ambition, you have to worry about how they're funding it.
Right. Most companies in this position are fragile. They're running on fumes.
But this company...
Yeah.
It's operating with what I can only describe as a financial fortress.
That is, hands down, the most compelling part of their stability profile. After that recent equity raise, their pro forma cash balance is sitting at roughly $840 million.
That's not a buffer. That's a strategic weapon.
Yeah. I mean, think about it. In a world of high-growth tech firms that are constantly fundraising, this company is sitting on an aircraft carrier full of fuel.
And their current ratio. I mean, we don't have to get too deep into the weeds, but the number is just exceptional.
It's powerful. Their current assets outweigh their current liabilities by more than 15 times.
15 times. The sector average is what, maybe 1.5x, 2x on a good day?
A 15x ratio gives them unparalleled stability. They can handle delays, supply chain shocks, R&D investments. They won't even break a sweat.
And there's almost no debt. Just around $11 million.
So that gives them maximum flexibility. They can focus entirely on growth and market dominance.
Which is necessary because they're positioned at the intersection of three.
Yeah.
Just huge structural growth themes.
Right. If you're betting on ONDS, you are betting on their ability to execute across all three.
So you have autonomous systems, you have counter-drone tech, and industrial wireless networking.
And we've spent a lot of time on the defense side recently. That's where their M&A strategy is centered.
Specifically that transformative $225 million acquisition of Sentry CS.
An Israel-based company. So for people who haven't tracked them, what did ONDS actually buy for $250 million?
They bought market leadership. They bought integration capability in the counter-UAS space.
So neutralizing threatening drones.
Exactly. Sentry CS brings the sophisticated detection, the kinetic capabilities. It's a massively complex, high-margin, and rapidly growing market.
And we saw proof of that translating into revenue almost immediately.
That $8.2 million contract, the one to deploy their Iron Drone radar systems at a major European airport. That shows the tech is being adopted globally right now.
But that's just one of the three pillars. We have to talk about the industrial wireless side.
Yes, which often gets overshadowed by the flashier defense contracts, but it might have the highest margin potential long term.
So for the average listener, what does industrial wireless networking for critical infrastructure actually mean?
It means providing these highly reliable proprietary communication networks for systems where failure is just not an option.
Okay, so think railroads, utility grids.
Railroad signaling, grid optimization, mining operations, smart ports, yeah. These operations need instantaneous, secure data to control assets over huge areas.
So we're not talking about Wi-Fi or standard 5G.
Not at all. This is mission-critical, dedicated spectrum technology. It's designed for safety and efficiency.
And that gives them access to these long-term, very sticky contracts with utilities and industrial giants.
Exactly. It provides a deep, predictable revenue stream that helps balance out the lumpiness you can get from defense contracting.
So the thesis is, use the Fortress balance sheet to buy cutting-edge defense tech while growing this predictable, high-margin industrial business on the side.
That's the game plan. And that's what's supposed to get them to that.
Yeah.
Eye-watering $110 million revenue target.
Okay, so that's the strategy. Now, let's shift to what investors should be watching over the next few months. There are several immediate catalysts here.
The most obvious one is the Q4 earnings report. That's expected in February 2026.
And given the momentum, everyone's already baking in continued triple-digit year-over-year growth.
Any upside surprise there would, I think, trigger a pretty significant rally.
But the biggest moves often come from operational news, not just the quarterly report itself.
Right. Management has been signaling that we should be watching for imminent contract wins, major product launches.
And that's across both segments, defense and commercial. We're expecting new U.S. and European contracts that leverage that Sentry CS technology.
And don't forget the regulatory side. Potential government approvals for expanded drone exports or, crucially, civil aviation applications.
That could open up huge new global markets. And if they get the green light for their networking systems in more critical domestic infrastructure.
It's a floodgate of predictable contracts.
Now, on the technical side, the market has definitely noticed this story. The stock has been, well, highly volatile.
To say the least. It rallied from a low of around 57 cents to a high of $11.70. It's now consolidating near $7.50.
That consolidation is actually a healthy sign. It suggests institutions are absorbing shares.
And it's staying well above its 50-day and 200-day moving averages, so the bullish trend seems intact.
The technicals suggest a 3-month bullish trading range between, say, $6.25 and $11.70. High confidence and continued momentum.
Of course, with a stock this active, you can't ignore the market chatter, the rumors.
And we have to stress these are unconfirmed, but the market is rife with speculation right now.
So what's the biggest one swirling at the moment?
It seems to revolve around the Sentry CS deal. There's chatter about further imminent defense contracts, not just another airport, but bigger government or military programs.
And what about on the industrial side?
Speculation about partnerships with major Fortune 500 firms to expand their networking business into new sectors.
So the market is coiled. It's ready to react immediately to any news that validates that big revenue target.
Exactly. But we've talked a lot about the growth. We need to look at the other side of this, the risks.
The number one challenge has to be execution. This is a massive leap they're trying to make.
It's still an early-stage, unprofitable company. And you have to ask, can they successfully integrate a large, complex international acquisition like Sentry CS while also driving 6-fold organic growth?
If that integration stumbles or if those high gross margins don't materialize, the whole investment thesis just collapses.
And the other primary risk, the one shareholders have to grapple with, is dilution.
The cost of all that growth funding. They funded it by aggressively raising capital through equity,
which led to a share count increase of 352% in 2025 alone.
That number is critical. People need to understand what a 352% increase in shares outstanding really means for them.
It's the unavoidable trade-off. That capital funded the cash hoard, it funded the Sentry acquisition, which is great for long-term growth.
But it fundamentally pressures your personal returns. Your slice of the profit pie, when it eventually arrives, is automatically cut. You're demanding truly exceptional growth just to break even.
And we mentioned the volatility earlier, but you have to internalize that risk. The stock's beta is 2.38.
Meaning it swings more than twice as wildly as the broader market. This is absolutely not a stock for the faint of heart.
And while their balance sheet helps, the competition is fierce, especially in defense tech. They're up against established players with decades-long relationships.
So if we zoom out and look at the whole picture, what's the single most important thing to monitor? What tells us if this is all on track?
It has to be the pro forma financial filing, the one that's expected after the Century CS deal closes, probably around December 2025.
That's a reality check.
It is. It will combine the financials of both companies. And investors have to scrutinize the new combined revenue run rate and, most critically, the path to those high gross margins.
And if the numbers in that filing suggest they're on track for, say, 70% gross margins in the next few years,
Then the acquisition is validated. If not, expect turbulence.
Okay, so to synthesize all this, the core thesis is a company leveraging an unprecedented financial war chest to execute a lightning-fast growth strategy in mission-critical tech.
Yes, it's a compelling narrative. It's driven by these dual growth engines, visible defense tech and long-term sticky industrial contracts.
So it's attractive for both short-term momentum traders and long-term investors.
It is. The traders can play the catalysts we're expecting next quarter. The long-term holders are betting on the company achieving serious scale and validating those high-margin promises.
So a high-stakes play, totally dependent on perfect execution over the next 18 months and funded by shareholder dilution. A true high-risk, high-reward situation.
We will certainly be tracking those Q4 earnings and that Century CS filing very, very closely.
Thank you for tuning in to our analysis of ONDS Holdings. Make sure you hit that subscribe button. It truly helps us cut through the noise for you every day.